Investors in the United States clearly were paying attention to China this week because China seems to be clamping down on yet another industry almost every day. We started with tech, and then we went on to things like media with reports they're going to clamp down on that. Now we're talking about cosmetics and liquor manufacturers. It's raising questions in some people's mind. Goldman Sachs said a lot of their customers are asking, is China investable at this point, just because Beijing seems to be almost capricious?
Every investor will have to make their own judgment. Those who are serene about China remind me of those who are serene about inflation. Bad things keep happening, adverse surprises keep happening, and they keep explaining them in terms of specific factors and resisting the idea that there's some kind of emergent general pattern. And I think there is an emergent general pattern, not that China's going back to Mao, not that China's going to entirely renounce the market system, but I think the risks for foreign investors are going up and have to be going up at a time when the greater insertion of the Communist Party into every private enterprise is emerging as a very important priority for the Chinese government. So it's certainly a riskier environment, and I think that when you have a riskier environment, people demand much higher returns, and then there's a question as to whether, given the tensions between our nations, the much higher returns that are necessary to compensate for much greater risks are going to be politically sustainable for a long time in China. So I think anxiety is the right thing.